It's the year of the Refix. If you've got a mortgage renewal coming up, you're in good company. Just over 80% of all mortgage borrowings will experience a reset this year, and that's the highest we've seen in a 12-month period for the past 13 years. So what have people been doing? Generally speaking, fixing for very short terms or floating. In the most recent data that we've got to hand from the Reserve Bank, that's for November, just under 50% of all new mortgage borrowing in that month was on a floating term, and if it wasn't for floating, it was on short fixed terms, such that only 6% in that month fixed for a period of 1 year or longer. That short-term strategy has tended to pay off because the Reserve Bank has been aggressively cutting the official cash rate and mortgage rates have been falling. That may well remain the case over the coming months, because I think the Reserve Bank is set to cut the cash rate again next month by 50 basis points and a few more cuts thereafter, which, if delivered, will mean that those short-term mortgage rates probably keep falling a little further. At the same time, we've just put out a note offering a couple of other things to think about. The first is that a borrowing strategy concentrated at those shorter terms does mean that a higher share of future interest payments are more uncertain. That's not necessarily a bad thing, of course, but it does increase exposure to any unanticipated shocks that might come along this year. And the second is the role of expectations. Now, current interest rates, particularly those for longer terms, already bake in an expectation that the Reserve Bank will keep steadily cutting the cash rate this year. That expectation is why, for example, the 2-year fixed mortgage rate is quite a lot lower than the shorter terms or floating mortgage rates. But it also means that for those longer term rates to keep falling, you need not just the OCR to be cut further, but that expectations for about 100 points of cuts this year need to be ramped up. So the hurdle to see additional declines in those longer term rates, if you like, is higher. It's something to think about for those pondering when or if they might term out some of their debt. Added to this is the fact that remaining on those short terms costs more up front, and we've put a very simple example in the note to illustrate the dynamics of this through time. And bear in mind that analysis makes no allowance for the extra non-financial benefit you might get in, say, sleep quality from a more highly hedged scenario. The point is that while mortgage borrowing for short terms might make sense given the potential additional short-term interest rate relief, there are a few other things to counter that as well. Have a look at our note, which is called the Year of the Refix. That's got all the detail.